Hello and welcome to ADIPEC Energy Dialogues, a series of conversations that we're bringing you in the run-up to ADIPEC 2020 in November. We're talking to leading analysts and energy experts from around the world, bringing you up to date with news and views that are impacting the oil and gas market. Absolutely delighted today now to be joined with the founder of Ziemba Insights. She is also an adjunct senior fellow at the Center for New American Security, Rachel Ziemba. Thank you so much, Rachel.
Thanks for having me.
Now, talk to us a bit about what's happening in the market here. We're seeing some strength come back in the market, but again, can we sustain this strength? And of course, the danger is, for how long and how solid is this? Prices got up there to about $40 a barrel, but we really need this to happen. But how long do you think we can actually keep this strength in the market?
So I think the big question comes down to demand and how quickly demand will come back. We have seen a couple of trends. We've seen countries start to exit from lockdown. One positive sign for demand, I think, has been on the side that people remain unwilling to go on public transport. So they're actually more likely to drive in their cars if they're going around. And that car travel has maybe recovered a little more. But, we're still looking at an economic recovery that's likely to be fairly modest.
And again, I think when we look at that, we've seen over the last few years really a consumer-driven economy in very much. And once that consumer has pulled back, and that disposable income as well is not there. So I think it's a series of issues that are impacting the market and pulling the demand. And we're looking at some economic figures out there really, and looking at contractions in some market. This is going to have huge economic impacts, and indeed not just for the next quarter, but probably right through the end of the year and maybe beyond.
I think you're right, Edna. One of the trends so a couple of things we're seeing in the data right now. One is that maybe the demand loss has bottomed out. Maybe we've hit sort of rock bottom and things are starting to improve from rock bottom. But that can be quite painful as you're bouncing around in that weak position. The other challenge is that, if anything, consumers are likely to recover more slowly than other sectors like manufacturing. What we've seen out of China, for example, which is such a large source of global demand for energy and other goods, is that manufacturing has bounced back much more than consumption. And that is something we could see in other countries as we start exiting. And it's notable that this crisis, the COVID crisis and the associated economic and energy crises, has really been the first hit to the global consumer. 2008 was much more of a hit to the financial sector and manufacturing. This time it's the reverse. And when we think about the long-term drivers of energy demand, it's very much linked to consumers. And so one of the sectors, for example, that's probably going to lag is travel and tourism. And so if we think about the jet fuel component of demand, that's likely to lag others.
And indeed, we're beginning to see, I think, some airlines coming back into the market, the gradual opening up of economies, which is all good news, and it makes good headlines as well. But just as you said there, we're seeing some manufacturing, particularly in China, come up. But will the demand be there? Because I think we're seeing also a kind of approach with caution. And this can't be good for the economies, particularly when we're looking at figures in particularly some of the emerging markets too, of a huge contraction. What can people do?
Yeah, so I think what people have been doing is realize that they can't just wait for demand to recover, and that the supply response is critical. And that's actually where things have probably changed the most in the last 2 months, right? From the sort of rock bottom moment of both oil prices, but also output and output losses. We have seen a lot of production coming offline, and particularly because of the OPEC Plus agreement, but also because of very low prices meant that places like the United States that are very market sensitive, we have seen a lot of reduction in activity. And so I think there's been relative success on supply adjustment. The challenge is a few places are bearing the brunt. And the challenge, I think, there will stand whether there's a lot of excess still to be worked off. So I think demand will recover slowly, and I think it'll take well into next year before we get to volumes approaching where we were at the end of 2019. And then I think there's a broad question of whether countries go ahead with what we maybe would call green stimulus or brown stimulus. Where are we with decarbonization? Where China's concerned, I actually think we might see some doubling down on getting rid of internal combustion engines or reducing their prevalence, because that actually supports the auto sector more, because they're producing a lot of electric vehicles. So that indirectly might support natural gas more than it does oil. And you mentioned India. India has been a critical driver of demand growth in the last few years, tapering off a bit in 2018 and 2019, but still one of the big drivers going forward. India has seen such job losses under lockdown. And I don't think doesn't have the finances to sort of start adding to their strategic reserves. And it's been surprising to me that we haven't seen so much reserve stockpiling in this iteration.
Yes. And indeed, we've heard many times from the minister as well, really, I think the frustration that he has, because I think you also look at huge economies in many regions in the world too, and particularly I think in developing countries, that they're not the same consumer profile as we see anywhere else. So it's really, really hurting people. And again, while we see some strength coming back into the market, they do need a lower oil price for their economies. So a lot going on. We'll talk about that in just a minute, but I want to come back and touch right now on what's going on with OPEC. Here we are in the final month of the first half of the year, almost a crucial time, psychologically a crucial time here, where we're looking at one half of the year finish, so to speak, and then people gearing up with hopefully a sense of optimism for the second half. Now, they do have to come together and they have to look at these figures, 9.7 million barrels off the market, and possibly even more when we brought in the wider support I think they have. Do you believe they succeeded in doing what eventually was agreed upon? And what needs to be done right now to maintain the momentum?
Sure. So I think it was a very rough start, right, for OPEC Plus, partly because after the failed attempt to balance the market in March, with the sort of the Russians really walking away from what in reality was not going to be enough to balance the market. I think within about a week of the failed meeting, it was clear that the amount that was on the table for cuts would have barely made a dent. But still, sort of going into this agreement, there was this unprecedented situation of boosting supply at a time when demand was falling through the floor. And while there have been some examples in the past where that's happened, including in the 90s, there's been nothing to this extent, nothing with such a sharp drop off in demand. And so that war and challenge, I think meant there was even more excess supply to deal with. So I think there's been relative success in tightening the market, largely because Saudi Arabia and the GCC countries, as usual, over-complied with the agreements. Russia mostly complied. But there's been enough, and the market pressure took some of the higher cost supplies offline, which was, in a sense, part of the big battle to begin with over the last few years. So I think there's been relative success. The challenge is that there are a few countries that are bearing the brunt of the adjustment, and some of the countries that are most economically strapped among oil producers, Nigeria, Iraq, Angola, are among the country, and Kazakhstan are the countries that are not complying in full. Some of them barely reduced production. And I just think it's going to be very difficult for them to comply, because these are countries that had big fiscal deficits when oil was $70 a barrel. And they were producing more. And they're countries with quite large debt burdens. So they really, I think the pressure that we're seeing from Saudi Arabia, from the GCC, from Russia, to have these smaller countries pull their weight, I think that's going to be very difficult to actually comply with. Maybe there'll be some face-saving solution, but I do think the most likely scenario is some rolling over and continuity, an extension of the supply cuts. But what I think is the other challenge is we're starting to see signs that the U.S., parts of the U.S. shale that have this degree of resilience, some of them are starting to reverse their shut-ins. And that's really not what Saudi and the Gulf want to see.
Absolutely. And I think when we look, let's just stay for a moment in terms of the, the differences in those emerging markets and the smaller players. Because as you say too, they've got fiscal deficits. Many of them have not diversified their economy, and they're absolutely dependent on oil income for their social programs. We're looking at, I think, a stop-start economy and social good and benefit of the countries, which has been really, really hard. And this is going to really, hit them another severe blow in many ways. It'll probably put them back probably several years. It's tough for many of them. Would you agree?
I would. And so that has the net result, they're facing, some of the weakest oil producers are facing several shocks at the same time, right? Especially those that have sizable outbreaks of the virus that may or may not be under control yet. But they're also facing financing pressures. What we've seen in the last month and a half, just as oil prices have come back from their low and brief period of negative, sort of negative territory of the futures market, we have seen a number of bigger emerging market economies return to the credit markets. Investment grade credits like Saudi Arabia, countries like Mexico, Indonesia, are all countries have been able to issue debt. It costs them a bit more than it did in December or January, but not an awful lot. And that's really been a function, I would say, of bottoming out, but also that the Federal Reserve is pumping in so much liquidity in the system. But smaller countries, those that are already maybe pricing in default, those don't have the same degree of credit access. And we've really seen, the IMF is very busy these days. Over 100 countries, not all of them are oil producers, but over 100 countries asked for emergency funding.
And looking at Saudi Arabia now, they just announced, the central bank announced that they're going to pump in, an additional $13 billion. They can do that. And many of the countries, indeed, in the region to have strong sovereign debt funds. But as you say, it's the danger, this is not all created equal, and there has to be some sort of safety net. And I guess, as you say, it's the IMF and people like that hopefully can come to the rescue. But can they do enough? And can they do it quick enough? And is there a danger that this is going to be such a prolonged recession that we're going to see some, longer lasting damage?
Yeah, so I think so far the IMF response, and they are working at the fastest pace they probably have, but I would probably characterize it as saying it's too little, too slow, and many countries don't qualify. So for example, the G20 nations all agreed for a debt standstill for the poorest countries. Many oil producers, even these ones that are in a tougher position than their rich peers, they're actually too wealthy to qualify for debt relief. So they're caught there. The other challenge really comes down to the Chinese response. China is one of the largest, not only is it the big buyer of oil and supplier of products, but it's a big provider of liquidity. So for many countries, their biggest debt burden is to China. So so not only are they asking for new money today, these countries, Nigeria is a key case in point, but they're also asking this question of, well, what about canceling the previous debt? And so that, I think, is going to be challenging. So I think overall, you might have a number of countries able to eke it through. But what I'm worried about is, even with some of this support, a number of countries are going to be cutting government spending. It's actually going to be pro-cyclical in a bad way, because they are going to be cutting government spending exactly when the private sector, such as it is already contracting, when the banks are lending less. And so I think this could be quite difficult. And then we think about countries like Iraq, like Algeria, that had very extensive social unrest last year and at various points. If you cut public sector wages or cut allowances and transfers, I think that's quite difficult. And then at the same time, for some countries, the remittances that they used to receive are not happening.
So the dilemma I think that people are facing, I mean, this also poses, geopolitical risk, and it also poses social risk, because the oil market, as good or as bad as it can be, as we say, is not created equal here. And a lot of these countries, depending on it, they need the money because they need to get industry back. They need to get their people back to work. So I think in a way, the combination of the social, political, financial dilemmas that countries are facing has really put everybody in a dire situation, I think. And, we're not going to see a way out probably till the end of the year or maybe longer.
I think you're right. I mean, of course, it's easier to be dealing with some of these challenges when oil has a 3 handle or closer to 4 handle as opposed to 2 or 1, which some sort of market forecasters were thinking that would be the story through the third quarter. But of course, we have to remember that it's not just about the price per barrel; it's also about how many barrels are being pumped and what the returns are. And then there's also a question mark of it may be easier for the energy sector to come back a bit, but the other parts of these economies that depend on the energy sector might not. So I think there's going to be this push-pull. And so I think in some of at a global level, my expectation is this is somewhat of maybe either a U-shaped recovery, or we might see a bit of some W action. So I think this is a challenge. And if anything, all the challenges that energy producers have been facing for the last 5 or 6 years, if anything, this sped up some of those challenges. We saw some adjustment after 2014, 2015, a lot of hit to especially oil services companies and the like. I think we will see sort of more pressure on those supply chains. But the big challenge, I think, comes back to or another challenge is that these energy producing countries used to be a big source of demand growth themselves. And that I don't think is necessarily going to happen. So,
and we're probably going to have, as you said too, we're going to have to wait until that happens. Let me bring you back to the US, because of course, the different dilemma there is the low price pulled some producers out of the market and shut down wells. But now we see this price edging up. And again, a bit of reliability, a bit of resilience, a bit of hope coming back to the market. Are people coming back in terms of new producers? Are the producers coming back in? And what's the danger of this? Because if we have more oil on the market in the US and the demand is clearly not there, we're going to get back into a situation of imbalance again.
You're completely right. So I think so far we've seen a very modest reversal of some shut-ins. We're starting to see a little bit more rig activity after many weeks of declines. We're only seeing it in some of the lowest cost areas, and we're seeing it in places for companies that have squeezed their supply chains. So I think that they will be very selective, but at this sort of mid-30s into a 40 range, there will be more entities that can make some money off of it, and the like. And the risk, of course, of that is that it puts even more pressure on OPEC Plus to sort of cut to adjust the market. And it also puts more, I think it puts more pressure, and I would say adds to some of the trade and investment tensions the trade war and the like, we've already seen that, for example, China is far behind meeting their targets of the energy as well as agricultural products they agreed to buy, given everything that is going on with both Hong Kong, but also US concerns about Chinese tech and other investment. I think things are going to get worse. But I think we're in an environment where there's likely to be more and different government intervention in the energy markets. The energy markets, of course, with so many national oil companies, there's always a sizable government and geopolitical component to energy markets. So that's not exactly new. But we have countries like the US and Canada being maybe willing to get government entities and regulators into the market in a way that a year ago we might have thought very unlikely. So I think the big kind of push-pull sort of here in question in the US. So in the US will be very important, again, on the supply side, but also on the demand side. This question mark of, will the US consumer come back? How much will people leave cities and go places where they need to drive more? On the margins, there's some of that, but we're at a point where more than 40 million Americans are out of work, and I don't think that number is going to come down quickly. And even those who maybe are back to their jobs, they might be making less money. And so you could make an argument, a month ago, one could make the argument that oil was really cheap and filling your tank of gas was really cheap. We might end up in a circumstance where we can't say that so much anymore. And so I think this all adds to a risk that we have shorter term cycles economically, but also in energy markets. And that becomes problematic because companies invest for the long term.
So again, it introduces even more volatility, and the expectation of volatility is even what makes the market a bit jittery. Tell me, as we wrap this up, when we look at the industry right now, a lot of cuts have been made. You know, we've seen a resilient industry, and we hear that every time the oil industry goes through this, it will come out a stronger industry. But this could be perhaps a longer period too, that tests the industry. When we look to perhaps the longer term, and demand is definitely there when we look at the longer term, but what can industries do, I suppose, in the medium term, you know, to just get through, to you know, survive this recession particularly, and at least get through, whereby investors look at a healthier industry in months to come?
Sure. So I think there are a couple of trends that are that are happening and likely to happen to a greater extent. One is that I think we will see some consolidation, particularly in the United States, that I think we might see some of the more cash rich entities looking to go into smaller, more speculative areas that are lower cost. Of course, one important part of the story has been things like cutting dividends and reducing payout to shareholders, particularly those that were financed via debt. So that's not just an energy industry related story. I think some countries that are making capital available to energy companies, those like Canada, for example, they've actually made that a requirement of getting any government funds. And so it means that some companies may not want to take them up on it. So cutting those dynamics. The other challenge, I think, particularly for countries that depend a lot on investment and jobs, one of the bigger challenges that we might see further job cuts to become more lean. Energy, the oil and gas is a capital intensive more than a labor intensive industry, of course. But there's been some trimming, there. Other things I think we could see might be companies themselves looking to see whether they can boost commercial reserves or partner with governments. One trend I'm watching, well, we can end there, is whether we might actually see more NOC, national oil company to national oil company partnerships. So for example, between the Middle East and the Middle East producers and Asian buyers, we might see more, not only stockpiles, but also new kinds of contracts. That may happen a bit more on the natural gas side than it does on the oil side, but there might be time for some creativity in payment terms and contracts.
Well, I think it is about, looking at this with fresh eyes, with new eyes, and really looking at new dynamics in the market, because it has created that over the last few months. And I think everybody has had time, enforced time in many ways, to really just look at it's not business as usual, and nor will it be for the end of the year. Rachel, thank you so much for giving us your insight. Still a lot of issues there, and I know in the ADIPEC Energy Dialogue, we probably pose more questions than answers, but that's what it's about. It's about the dialogue, and it's about people coming together and sharing views and really looking and examining and really, I think, helping each other to see a way out, because we're all in this together. We've got a few months to go, I think, and as we turn the first half of the year, a lot of looking back, looking forward to be done. Thank you so much again, Rachel Ziemba. Thank you for joining us. Great to see you. And to all of you at home, thanks for being with us on this ADIPEC Energy Dialogues. Of course, all this in the run-up to ADIPEC 2020 in November, so stay with us. We'll be bringing you up to date every week to keep you informed about what's going on in the oil and gas market. Thank you so much.